Hi, I'm Christian Gopal, here with my colleague Louise Street, and we've just released our Gold Demand Trends Q3 report. Lou, it was a remarkable quarter, wasn't it?
Yeah, it was extraordinary. Obviously, the first half of the year was extraordinary. You know, we saw gold breaking record levels, and then Q3 saw just an extension or possibly even acceleration of that trend, breaking multiple new record highs, 13% up during the quarter and then 27% since the beginning of the year.
And we've continued to see gains in the gold price into October. Now, we know from experience that can be a double-edged sword with different sectors responding differently. If we start with investment, what did we see there?
Well, we saw the return of Western investor interest in the ETF space, something we've been sort of calling for. We've highlighted that in our outlooks for a couple of quarters, and that finally came through in Q3. We saw inflows into US and European listed funds, and that had a notable impact on the price, that contribution to the price increase in Q3, and also to those year-on-year comparisons, because in Q3 last year we had really significant outflows. So when you compare that with the sizable inflows we saw in Q3, that really helps to lift those year-on-year demand comparisons. We also saw the OTC, the over-the-counter sector of investment demand. Now that's been quite a significant component of demand now for 7 quarters. It covers a multitude of things, that component of demand. There are different elements that feed into it, but one that we've highlighted, a trend now for a good year and a half, has been high net worth investors, and that continued to be the case in Q3. And while from time to time we might have highlighted a specific markets, Turkey and US, for example, have been prominent in certain quarters, it's really been a global phenomenon and seems to stay that way.
And what do we think is really driving investment?
So if we look at that kind of element, that we can sort of group together the institutional, professional, high net worth kind of space, in terms of their recent motives for investing, it's been falling interest rates, particularly with that surprise 50 basis point cut by the Fed in September. It's been just general ongoing heightened levels of anxiety and concern over geopolitics globally. Increasingly over the last quarter, the uncertainty over the outcome of the US presidential election, and that ongoing need really for good portfolio diversification. And frankly, I think in the last quarter, what we saw was FOMO, investors who really feared that they'd missed out on that first leg of gold going up earlier in the year and just determined to kind of now get in and make the most of the current price momentum.
And that fear of missing out is somewhat understandable given all the headlines we've seen dedicated towards gold and its performance. But if we look at the bar and coin side, which tends to be smaller scale investment, we actually saw that moderate in Q3.
It did. Global bar and coin demand was actually down 9% year on year. Might seem a bit surprising, but it was really due to sort of a handful of quite key markets. So China, in Q3, we saw the currency starting to strengthen. We saw the government obviously unleash that whole kind of economic stimulus package, and that really seemed to take the heat out of safe haven demand in China. And another key market where we saw a sharp drop was Turkey. They've got astonishingly high domestic interest rates still, and just seeing those kind of investment funds being diverted away from gold and really into savings accounts where they can earn those strong rates of interest.
Now, India in particular was a bit of an outlier. The duty cut that we saw in July had a really significant impact on the market during the quarter.
It did, yeah. The government slashed the gold import duty by 9%, which had an immediate impact in terms of the domestic gold price, and that sparked this massive consumer response, both for bars and coins as well as for jewellery. So a lot of people pulling forward the demand that they'd planned, the purchases they'd planned for the Q4 traditional festival season and wedding season, and that translated into a very strong rise in demand in Q3.
Now, you mentioned jewellery. Now, India again was an outlier in the quarter. If we look at it broadly, the price impact really did mean that we saw a bit of a weaker picture in jewellery as a whole. Widespread
weakness in jewellery as a whole, which, given what was happening, the price was entirely to be expected. So when you compare the volume of gold that people were buying in Q3 this year compared with last year, yes, it was significantly lower, which makes sense. What we often see in gold, though, when we saw it in Q3, was that if you sort of make a rough calculation of what the value of that gold is that people are buying, it was actually up by 13%. So although consumers are obviously working to a budget, it appears that even when gold prices are rising, they're kind of prepared to push that budget and spend a bit more when it comes to gold jewellery, which is encouraging.
So if we take a look at a slightly less price sensitive sector in the market, that's central banks, we actually saw their purchasing moderate again in Q3.
So we saw a record first quarter this year for central bank demand, and then since then we've seen it sort of progressively slow down, quite a sharp slowdown in Q2, and again a bit in Q3. But as you say, central banks are a lot less price sensitive than many other areas of the market, and we kind of don't see it impacting strategically their buying decisions. It might sort of at a more tactical level, and we think that's what we saw in Q3 essentially. It was kind of a bit of temporary pause by some central banks just in relation to the sheer strength and speed of that rally. But taking a step back, looking at central bank demand and kind of through a longer term lens, if we look at where we are year to date, we're pretty much in line with where we were in 2022, and that ended up being a record-breaking year for central bank demand. Now, we're not expecting that that's going to be repeated this year with a stellar Q4 necessarily, but I think it just goes to paint the picture that 2024 is still shaping up to be a very good year for central bank buying again.
And if we look at the final and smallest element of demand, that's technology, are we still seeing the AI boom that we've spoken about previously support things there?
We are. We saw a year-on-year increase in demand from that space, as you say, kind of supported by AI. I mean, it's important, as you said, to kind of highlight that it is the smallest part of the gold market, so the volumes aren't large, and actually the year-on-year comparison is with a relatively soft Q3 of last year. But there's some really interesting developments going on in that space, which are helping to boost the gold demand. So AI-enabled smartphones, low Earth orbiting satellites, these are areas that are predicted to grow quite significantly, and they rely on gold as a critical component due to its reliability.
And finally, if we take a look at the supply side, what were the key stories there?
So mine production, we've seen record mine production in each quarter so far this year, so it seems likely that we're going to beat the previous high in terms of mine production from 2018, although should caveat that not all companies have reported yet, so we're sort of working on partial data. I think the interesting part of supply has been recycling. Given what's happening with the price, we haven't necessarily seen that huge response in terms of an increase in recycling that we might have expected to see. And I think that speaks to a couple of different things. It's that much of the near market stock of gold that's ready to be recycled they've already done so. I think some people are perhaps waiting for, they've seen the price rise and they're maybe just holding back to wait for kind of higher prices still. But I think that also then kind of implies that we're not seeing distress selling. Consumers aren't selling because they absolutely have to. They can actually afford to wait and see if they can get it at a higher price. So again, that's quite an encouraging story.
Well, that's a lot of interesting insight there, Lou. Thank you very much. If you would like to read the full report and see all of our data and insight, please visit us at goldhub.com.